Hello everyone, welcome to another episode of Financial Tidbits here with me, Royston at NAOF. For today's video, I'll be highlighting a growth stock that I find pretty interesting and would like to share with my subscribers. I find that many of the growth ideas out there, mooted by influencers, have an inherent problem. They are sexy stories that can only be justified in terms of sales growth. No one bothers about how these companies are bleeding shareholders dry on the bottom line, as long as they continue to churn out higher top line growth. For many of these companies, driving revenue growth and winning market share is much more important versus generating a profit for shareholders. The rationale is that once they become the indisputable market leader in their area of operations, having wiped out the competition in the process, they'll have free rein to raise prices for their services or products, and users will have to suck it up. This is the case for many wannabe growth companies who essentially don't give a damn about how much they are in the red. Revenue growth is the sexy story they are spinning to entice investors to continue pouring boatloads of money into their loss-making business. That is, until that fairy tale story turns into a nightmare and funding disappears overnight when their top line growth ain't sexy anymore. When there's no longer a sexy story to narrate, many of these growth companies, which are also cash burners, find themselves in the situation where they are rapidly running out of capital. This is when their house of cards collapses. Therefore, when I look at growth stocks, I wish to make sure that their sales growth can be self-sustained, meaning that these are growth companies who are focused on growing their top line sales and might not necessarily be profitable, but the cash generated from their operations can continue to sustain their growth without the need for additional debt funding or equity raising. Now, there's this interesting growth stock called HubSpot, which boasts a market cap of 31 billion at present, and the company is in the business of helping other companies grow better through its CRM platform. The company is a typical growth company, growing its revenue from 271 million in 2016 to 883 million in 2020, with the street expecting revenue growth to double to 1.6 billion in 2022. While the company is growing its top line strongly during this period, its reported losses ballooned from 40 over million in 2016 to 80 over million in 2020. The losses were mainly due to stock-based compensation, which is where HubSpot rewards its employees and associates by giving them shares in the company. Issuing these shares has to be accounted as a cost in its profit and loss statement by international accounting standards, which hurts the bottom line of the company. However, HubSpot does not incur any actual cash costs through these issuances. Hence, it will be added back to operational cash flow. As the company does not need to spend a lot of money on capital expenditure to grow its business, the result is that it generates a ton of free cash flow, which goes towards increasing its cash hoard in the form of higher cash and short-term investments. This is a company that is witnessing hyper-growth in its business, as evident from its revenue increment over the past 5 years. While the company continues to be loss-making, what differentiates the company from other growth companies is the fact that it has continuously generated tons of operating cash flow. And because it does not need to be spending on capex to grow its business, there's plenty of free cash flow which the company can use as a buffer. The fact that HubSpot is growing its sales rapidly and is also consistently generating free cash flow has not gone unnoticed by the street, with its share price appreciating by more than 100% over the past 1 year. The company has set a target focused on profitable growth. While it continues to generate strong top-line growth, it should not be solely at the expense of incurring more losses. Instead, the company believes that if revenue can continue to grow in excess of 30% year-on-year, it should also target to improve its operating margin by 1 to 2 percentage points. If top-line growth tapers, then the slowdown will need to be compensated by stronger operating margin growth. While there are plenty of growth companies out there narrating a sexy story to attract investors, one should be aware that the share price sell-off could be fast and furious when the growth narrative is no longer intact. This is particularly the case if they are highly dependent on external sources of funding for growth. While I'm not implying that one should be avoiding growth companies, it is useful to note one's risk appetite. Are you able to withstand a more than 50% sell-off in discounters when their growth disappoints the street? Are you confident that these companies can continue to have access to third-party funding to grow their business? An example will be Fastly, a once high-flying growth stocks that every growth investor loves, as its sales growth narrative was truly a sexy one, until that fairy tale sales growth fell apart. I'm not implying that Fastly is a bad investment now, but investors or speculators who got in when the price was trading at more than $100 per share and when every growth investors were singing its praises at that instance must be feeling the pain right now. One key difference between a hyper-growth stock like Fastly and HubSpot is that Fastly is not generating any positive free cash flow and continues to run down its cash in a bid to excite investors on its growth story. That cash burn might not be sustainable when third-party funding evaporates. HubSpot, on the other hand, can continue to fund its growth organically even if there might be unforeseen hiccups to its growth story in the future. When investing in growth stocks, an investor will need a strong stomach to withstand a potential huge sell-off. I do invest in growth stocks as well, but I need to know that the sexy top-line growth story is also accompanied by an improving free cash flow situation. Having said that, I'm not implying that HubSpot will not have a Fastly-like sell-off. It could happen as well. Do your own due diligence to see if this company is indeed worthy of your investment. With that, we have come to the end of today's sharing session. If you have enjoyed this video, do hit the like button and subscribe to the NAOF YouTube channel. This is Royston signing out.